Today we're going to talk about the differences between monetary and fiscal policy.
Monetary policies are actions taken by the Federal Reserve that influence the money supply and ultimately the spending in an economy. This can include increasing or reducing reserve requirements and the discount or federal funds rate. They can also use open market operations, which is the purchasing or selling of bonds. Fiscal policies are actions by the government that aim to influence aggregate demand in the economy. This can entail either cutting or increasing taxes and either reducing or increasing government spending. Monetary policy is the direct actions that the Federal Reserve System takes to influence real GDP and the inflation rate. Its main goals are to influence economic growth, whether this be through expansion or contraction, achieve full employment, which is 4 to 6%, and maintain a stable inflation rate, which is about 2%. The Federal Reserve is the central banking system of the United States. It is made of the Board of Governors, who are appointed by the President and confirmed by the Senate to serve a single 14-year term. This board is led by the chairman of the Federal Reserve, who serves for 4-year terms. The reserve also includes the Open Market Committee and 12 regional reserve banks, who communicate between the Fed and private commercial banks. The Federal Reserve has 3 ways that it can influence the economy: reserve requirements, discount rate, and open market operations. Reserve requirements are the minimum percentages of deposits that banks must hold in their reserves, which allows the Federal Reserve to influence the amount of bank lending. When the requirement changes, so does the amount of new money made available by banks, which makes borrowing money more or less expensive for firms. The discount rate is the interest charged to commercial banks for loans taken directly from the central bank's treasury. Changing the discount rate may make borrowing money more or less expensive for commercial banks. In open market operations, the central bank buys and sells government bonds in order to increase or decrease the money supply. It is the most important and fastest tool that the Reserve holds. For all its power, monetary policy still has limitations. For example, its effects will take time to materialize, and this raises the possibility of economic problems solving themselves before the effects of policy really take place. And predicting the business cycle is always a challenge, as even the best economists can only do so much when it comes to predicting human behavior, and thus cannot account for every possibility.
Okay, so now on to fiscal policy. Similar to how in monetary policy those are actions taken by the Federal Reserve to influence the economy, here in fiscal policy they're actions taken by the government to influence the economy through consumer spending. So some of the people who can make these influential decisions are the President, Secretary of Treasury, or Congress. Okay, so some examples of fiscal policies are government spending and tax collection. Both of these experience the multiplier effect, where the initial spending causes more or less spending across the economy. Government spending impact is calculated using the marginal propensity to save, which is the amount of money people save when they get new money. This spending multiplier is 1 over the marginal propensity to save. Government spending shifts aggregate demand in the direction of the change, so when government spending increases, aggregate demand increases as well. Tax collection acts in a similar way. The tax multiplier is calculated by dividing the marginal propensity to consume by the marginal propensity to save, but it's often easier to calculate this by subtracting 1 from the marginal propensity to save. Change in taxes shift aggregate demand in the opposite direction of the change, so an increase in taxes decreases aggregate demand. Due to both of the equations for the spending multiplier and the tax multiplier, if the value of the change is the same, government spending often has a larger impact than tax collection change. To put this into an example, if the government wants to increase the total output of an economy by $40 billion and the marginal propensity to save is 0.25, how much will they have to spend? So first you would calculate the spending multiplier, which is 1 over the marginal propensity to save, so it would be 1 over 0.25, which is 4. So overall, the government would have to increase their spending by $10 billion in order for it to have a multiplier of 4, which would result in a total output change of $40 billion. Okay, so there are some limitations of fiscal policy, one of them being predicting the future, both the future of the economy and how consumers will act. Another one is the delayed result. Since fiscal policy is based on the multiplier effect, it can take some time for either injections or reductions of money into the economy to take their full effect on the economy. Another one is political pressure. Since the changing of government spending, and especially the changing of taxes, can be politically motivated or politically sensitive, it can be difficult to put a fiscal policy into place.
There are 3 ways that the Federal Reserve can encourage economic growth in a recession: decreasing the reserve requirements, decreasing the discount rates, or buying bonds on the open market. Think easy money, ways for the Fed to increase the money supply for consumer use. When the reserve requirement is low, banks push more money into the economy. When the Fed decreases the discount rate, banks borrow more money. When the Fed buys bonds on the open market, it puts new money into the economy in exchange for government assets. All these actions lead to an increase in the money supply, causing a decrease in nominal interest rates. This in turn sparks an increase in investment spending, which causes an increase in aggregate demand, causing the real GDP to grow and returning the economy to full employment.
Similarly, in fiscal expansionary policy, the government can increase its spending, which would create more jobs and therefore increase consumer spending, shifting aggregate demand to the right. And then they can also decrease tax collection, which means people would be able to spend more of their income, which would increase consumer spending as well, which would shift aggregate demand to the right and return the economy to full employment.
Like with expansionary policy, there are 3 ways that the Fed can discourage economic growth in times of high inflation: increasing the reserve requirements, increasing discount rates, or selling bonds on the open market. In this case, think tight money, where the Fed is decreasing the money supply to discourage spending and to decrease aggregate demand. When the Fed increases the reserve requirement, banks put less money into the economy. When the Fed increases the discount rate, banks are less likely to borrow money from them because it becomes more expensive. When the Fed sells bonds on the open market, it takes money from investors in exchange for assets. All of these actions lead to a decrease in the money supply, which leads to increased nominal interest rates. This causes a decrease in investment spending, reducing aggregate demand and causing the real GDP to contract and returning the economy to full employment.
Here, the government can decrease its spending, which would cause a leftward shift in the aggregate demand curve, which would let the economy return to its long-run equilibrium. They could also increase tax collection, where consumers would start to hold on to more of their incomes, and would decrease consumer spending, which would also shift the aggregate demand curve left.
So a summary of expansionary policy versus contractionary policy is that even through fiscal and monetary policy, when it comes to expansion, both seek to increase aggregate demand, while for contractionary policy, both fiscal and monetary seek to decrease aggregate demand.
So this is just an application of graphing fiscal policy. So say Neverland is in a recession. The government is looking to return the economy back to full employment. The government of Neverland would then cut taxes, allowing people of Netherlands to have more money to spend. This would increase consumer spending, shifting aggregate demand to the right and returning the economy back to full employment.
So as an example of an expansionary monetary policy, say the economy of the Willy Wonka world is going through a recession. So the central bank decreases the reserve requirement and the discount rate. This makes it easier and cheaper for both commercial banks and firms to take out loans. Because loans are a lot cheaper with decreased interest rates, the Willy Wonka company decides to take out a loan to build a new factory. Through this, the company hires new temporary and permanent workers and purchases a whole lot of new materials, which helps to increase the real GDP and ultimately return to the economy to full employment. Thank you for listening. Yay, economics!